Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take those opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders Weekly for the week of August 18th, 2024. In this week's episode, it's just myself, Sprocket888, and we are going to take a look at a short put. And this is a way where you can get paid to wait. And this is kind of a beginner episode, so we're going to go back a little bit and kind of cover some fundamental basics with a short put. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. You also find a link to thetagang.com/Sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts, so subscribe to us there, and if you can't find it, let us know, and we will get it there. Let's hop to this week's content. Now, this week's content is going to be a little bit more basic, so if you're all up on your short puts, maybe this won't be so interesting to you, but we are going to take a look at a specific short put and exactly what is a short put and why the heck might I want to trade a short put. And I decided to cover this stuff on this episode because I was talking with an individual recently, and they were a traditional trader, traditional investor, where they kind of long different stocks. And they had mentioned to me, they said, hey, you really should look at ALB. I really think ALB is going to take off at some point in the near future. And, I kind of said, I really don't just buy straight shares. I typically like to trade the options. And we kind of chatted a little bit about, what an option kind of is or what option strategy I might deploy on that. And because I'm not really up on my ALB ticker, I took a look at the ticker and looked at the option chain, looked at the volatility, and realized that this kind of was in a little bit of my wheelhouse as far as extended historical volatility. And so I kind of looked at that and I said, well, if you're really interested in going long on ALB, you might want to consider selling a put against it. And so this episode, I kind of want to go through the steps of why would you want to sell a put if you want to go long a particular share of stock. And we'll specifically be looking at the ticker of ALB. Now, as we jump into this, I'm going to kind of run through a set of prerequisites or things to keep in mind, things that have to kind of be true before we move on to the next stage of what I'm going to talk about as far as short puts or getting paid to wait, if you would. And so the ALB ticker specifically is really on a downward trend. And we're kind of wondering, hey, where's it going to turn around at? And so you have to know a couple of things. If you're looking at a ticker and you want to go long on it and you're in a downtrend, ideally you buy the bottom. Say, I'm going to wait till it gets to the absolute bottom and I will buy the bottom and then I'm going to go long that thing until it hits my price targets. Well, the first thing to understand is pretty much you will never, ever, ever buy the bottom of anything. If you happen to, it will be because of sheer luck or maybe insider knowledge or insider trading, of which you probably shouldn't brag much about that. So we're going to work on the assumption that there's no way that you're ever going to know when a particular stock is going to hit its absolute bottom and buy the bottom. Now, the next thing is if we're getting paid to wait, you got to kind of arrive at what is the price that you want to pay for a stock. And you have to be committed to that price because you'll see when we sell an option at that strike, you're going to be obligated to buy at that strike. And there will be a very strong tendency for you to want to change your mind as soon as you get down to that price because you're not going to buy the bottom. So chances are the stock is going to go lower than that strike price of which you decided, at some point, hey, I'll buy at this price because it will go probably through that price. And you'll say, no, I want to buy lower. And that's the bullet point that I'm talking about here. You have to be committed to the price that you pick when you go to sell your option. The next thing that we want to look at as we enter this is to get paid to wait. you're going to want, you can do this at any point with any stock that has options, but I tend to think and believe that this is more lucrative and more in the wheelhouse of things to exercise when we have a volatile stock. So the more volatile the stock is, the more premium that will be in the option, which means the more that you will get paid when you sell the strike that you end up selling. So if it's not so volatile, what will end up happening is very likely, you'll kind of maybe approach your strike. Your strike won't be that far away because it's not so volatile. And then if it happens to fall towards your strike, volatility will start increasing. The price of the option will increase, and you'll feel bad about it a little bit because you'll feel like you've left money on the table, because it will be more lucrative later as that volatility increases and as that price falls. So that's another thing to kind of look out for when you want to approach this strategy. My recommendation is you take a look at the very volatile thing. So if you have a particular stock that you want to look at, you look at the option chain and it's not that volatile, and I'll show you how. We're going to look that up in a minute. Maybe take a pass on this particular strategy. But if it is very volatile, that's going to be where I want to execute this type of play to get paid while I wait to buy at the price that I want to buy at. Now, the last point that I'll say is you have to be patient. So when you sell puts, this is one of the misconceptions of anybody that first sells a put. You are not going to get assigned as soon as your put hits your strike or goes below your strike. It's just not going to happen. In fact, you might go well below your strike and you will not get assigned. Early assignment is always a possibility, but the real assignment will typically happen a day or two to expiration, and it's only guaranteed at expiration if the option is in the money. And I'll talk about that as we bring up this particular example. So if you want to buy at, say, $40 of whatever it is you're selling, when you hit $40 and you go below and it's now trading at $39.50, you're inclined to say, oh, execute. But that's not the way that selling that put is going to work. You likely will not execute. So you run the possibility that $39.50 will now become $40.50, and you won't get assigned, and now you're out of the money. So this is not a guaranteed placement. It is a highly probabilistic placement, potentially, depending on the delta that you sell, but it is not guaranteed like a limit order would be. Now, before we hop to any of the discussion about ALB specifically or about some of the mechanics of a short put, let me talk conceptually about what a put represents. Now, we're only going to talk about puts. On Options World, there's also a thing called calls. In options, you can either buy them or you can sell them. Now, most traders, when they get started in options, buy options. We are not talking about buying options. We are talking about selling them, specifically selling a put option. So what exactly is a put option? A put option is a coupon that gives the buyer the right, not the obligation, to put 100 shares per contract to whoever sold the option at the given strike price of that option. So when we start talking a little bit about ALB, you're going to hear me talk about a $70 put strike. What that means is I'm going to sell a coupon at a $70 strike, which says if ALB is at or below $70, I will purchase 100 shares of ALB for $70 a share. And when I sell that coupon, I am going to sell it for some premium. So the buyer that purchases that coupon has to pay that premium. And I don't remember the specifics, but let's say it was, $2.50. So they're going to pay $2.50 per share, and a contract represents 100 shares. So they're going to pay me $250 so that they have the right, but not the obligation, to sell me 100 shares of ALB at $70 a share. So what does that mean? That means, let's say ALB goes down to $40. Let's say it just crashes and goes down to $40 a share. Now, as long as that coupon is not expired, and we'll talk about, days to expiration here in a minute when I bring up the example, but as long as that coupon is still valid, they are allowed to make me buy those 100 shares for $70 a piece. Now, for that right, they paid me $250. Now, what is that kind of like for me? If I am willing to pay ALB at $70 a share, I basically get to collect $250 to purchase at a price that I already want to purchase at, which will lower the cost that I actually purchased at by $2.50 if that's the premium that I collected. So it's like buying at $67.50. And the way you arrive at that is you take the strike that you have to buy and then you lower it by the premium that you collect. Because remember, I am collecting $250. Whether or not that goes below $70 or stays above $70, that $250 is mine to keep. Now, let's take a look a little bit about some of the mechanics about what am I doing when I go to take a look and take an approach at something like this. And there's a few different factors that I'm going to kind of take a look at that are generic no matter what the strike is. And then I'll talk a little bit about some of the specifics on ALB here. So the first thing that you have to do is, you should always assume that if you're selling a put, you could get assigned and you're going to go long those shares. So you don't want to sell a put at a price that you are not willing to buy the shares at. So that's the first thing you need to figure out is what price are you willing to pay, or what's your target price when it comes to the underlying shares. And I'll show you how I arrived at that on the ALB case. The next thing you're going to want to do is once you decide on the price that you want to pay, you're going to want to open up the option chain, and we'll show you this, and you're going to look at the delta and the premium associated with something near that price that you're willing to pay, called the strike price. And I'll talk a little bit about what delta means and what the premium is and how you can tell what that is based on the option. Now, the next thing that I like to do is you want to look at the bid and the ask spread. Now, just like in underlying of stocks and things like that, the bid and the ask, the bids and asks, that's what somebody is willing to pay for it, and that's what somebody wants to sell for it. And so the difference between that buyer and seller, the farther apart they are, the more what's called slippage that you're going to have, because you've got buyers at one end that want to buy at a certain price, sellers on the other end that want to sell at a certain price, and they're usually apart from each other, because if they were at the same point, a transaction would occur. And so what has to come in is you have to kind of come in and you offer your price somewhere in between those two numbers, so that whether or not you want to buy or you want to sell, you'll find something that is amicable to those people. Now, if you offer at the bid or you offer at the ask, your transaction will be immediate, but a lot of times you want to try to start at the midpoint to get a better price, slightly better price. And so when you're looking at the option change, you're going to want a very tight bid-ask spread. That means the difference between the bid and the difference between the ask is you don't want it too far apart. If it's too far apart, that means there's not a lot of liquidity, and there's going to be a lot of slippage in your order. So that's one of the prerequisites that I look at when I decide this is a stock I want to go long and I want to get paid to wait for it. The next factor that I look at is days to expiration. That's how long is this coupon good for? And there is a wide array of date ranges that this coupon can be good for. I tend to target, when I am selling premium, around a 35 to 45 days to expiration. Now, I won't go into it. You can look up other videos and stuff like that. But this coupon will decay value over time. The time premium in the coupon is called theta, and theta constantly declines over time. And it's not a linear decline. It's an exponential decline. And so once you kind of hit a tipping point, it starts to decline faster and faster and faster. And so because I'm selling this premium, I want that premium to erode away, because that's more value and more money that I can get to keep as that premium just kind of melts away. And so that tipping point of a more rapid deceleration or rapid erosion of theta really starts to kind of come out in that 35 to 45 days to expiration. So that's typically where I start. It's not a hard limit on one or the other. Sometimes I'll go down into 21, but I typically will not go over 45. But I'm looking somewhere in there. So let's talk a little bit specifically about ALB. Now, what I did with ALB, and I'll pull up a chart here in a minute, was I decided to look at a little bit of price action. Now, I'm not the best chart reader or price action plotter, but I do have a couple of basic things that I kind of look at when I try to go start and look at the target price. Now, when I looked at that, I typically, for a 35 to 45 days to expiration, I'm going to look at daily candles, and I'll pull this up in just a second. But where I came to is that it looked like there was a price level around the mid 60s to maybe low 70s per share. And what does that level mean? Does it mean it's going to go up and down? No idea. But it typically means that there will be some kind of reaction at that level. Now, if we start to gain off of that level, if we touch on that level and gain off of that level, it's highly probabilistic that we might be looking at a turnaround. Now, if we hit that level, break through that level, it's highly probabilistic that we're going to continue that downward trend. So because I'm getting paid to wait, I want to try to see, hey, what's the next level below where I am to sell an option at? And for me, that was kind of coming up in that mid 60s to low 70s price. And then we'll keep that in mind as I pull up the option chain on ALB. Now, the next thing I wanted to look at is where is ALB's option chain on historical volatility? Now, when I placed this trade, it was actually greater than 70% historical volatility. That's perfect. So what I like to look for is anything over 50%. If you get into the 100%, the 90%, yes, you can trade these, and I absolutely do, but you can get into some really kind of crazy moves. And so this 60 to 75% is really a sweet spot for me when it comes to historical volatility when I'm looking at it. So let me pull up the chart here of ALB, and I'll kind of talk you through some of my thinking when it comes to the chart. So this is a daily candle chart of ALB going back, several years, and you can see this particular stock, hit this high up here in the mid 330 range, and we have really been kind of on a downward slide since November of 22 on ALB. We've had a couple of kind of rallies back up, but they failed. Rallies back up, and they failed. And really what I'm kind of looking at here is I want to establish different price levels. Now, I won't go through all the various price levels, but if you kind of look at the most recent high, you can see, as this one fell through, this all-time high was kind of gained off of gaining this previous level. It broke through that previous level, which is an indication it's going lower. As it kind of came back up, it hit this previous level here, which was, the previous high to the all-time high, and that acted as a resistance point, and it rejected off of that and went lower. Then here's where we had a rally up. It broke through that support, which means we're headed lower. Again, we're kind of coming back up. It failed to break through that, and again, we go lower. And so it's all of these kind of levels that we're looking at. And so I threw on here this dotted line where I believe there is a historical level that is relevant to kind of where we are right now. And this one is called out about 67.50. But if I kind of slide back in time, there is this kind of consolidation phase here. Yes, it kind of went below there down into the mid 50s, but this is where we kind of gained, and it was off of this, pretty wide range here that we started building up to this 330 level here. And that's why I kind of marked it, and I said, you know what? It is highly probabilistic that we are going to get some sort of reaction down here in the mid 60s to upper 70s. Now, you don't necessarily have to come all the way back down to that level. You can come close to it. So it's really kind of a range. And so I decided, anywhere in the mid 60s to low 70s, I'll start looking at strikes when it comes to ALB. So let's move over to what's called an option chain. Now, no matter what broker you use, I happen to use Charles Schwab, and this is the Thinkorswim platform. Every broker is going to have an option chain associated with the underlyings if they have options. And every option chain is going to have an array of options expirations. And so these dates that you see over here on the left, these are when the coupon expires. So this is where I told you have a wide range of dates you can pick. You can't arbitrarily pick any date. They're predefined, typically on Fridays. You will always have monthlies. Those are the ones without anything by them. And then as you kind of move through time, there will be weeklies that will be published. Now, these will be every week. Not every option always has weeklies. Many, many, many do. but there is always at least monthly expirations. Now, I said we're going to look in that 35 to 45 days. So we're probably looking, at September 20th or September 27th. This is the spot that we want to look at. Over here on the right, these are the volatility levels of that particular strike. So you can see the ones that are closest here have about almost a 61% spot volatility. And then these both have roughly the same, 57.6 and 56.2. So let's go ahead and look at the 27th, which is 41 days. It's between the 35 and 45 days of expiration. So now what you're going to get is you're going to get a list of strikes. Now this is the strike. These are the strikes that are available to sell. You can't arbitrarily pick any price. You can only pick prices where strikes are available. And we're going to say, okay, let's look in that, mid 60s to low 70s. And so right here, 65 starts, and then these numbers are the bid and the ask. Now the markets are closed right now. So this is not a good judgment of the bid-ask spread. When I put this particular trade on, the bid-ask spread was around a dime, I think, between the two, which is very good. So when I look at the bid-ask, I'm usually looking for less than a quarter. Now, this is a little bit different than if you trade equities. So in equities, the bid-ask spread is almost like fractions of a penny or penny. In options, because there's less volume, you're going to get a wider spread. And so generally, I consider anything under a quarter difference plenty of liquidity and plenty of a spread to trade. And the other column I want to call your attention to is this far right column called delta. Now, I want to talk a little bit about delta because delta is your statistical probability of reaching that price. And you can think of this like a percentage. So, for example, if we looked at the $70 strike here, which is a really wide spread, again, because the markets are closed, but it has a 22 delta. What that means is there is a 22% chance that on September 27th, this underlying will be trading at or below $70. And so this is where, you're going to sell. And depending on how aggressive you want to be on what price you pick to sell at, you're going to change where you go. And so you could come up really close to, this was trading at $79.37 when the market closed. So these strikes right here where they go kind of black to blue, this is really close to what's called at the money or ATM. And you can see the premium is quite a bit higher here. Again, it's almost a 50-50 up here as far as that delta goes, because, at the money, there's no skew or anything, it's really a coin flip. Is it going to go up? Is it going to go down? 50-50 shot. So if we start looking out here at these strikes, you just pick, what strike are you comfortable? What strike are you comfortable buying the shares at? So for example, $70. If I'm good at buying at $70, I might click on this to then pull that up and put that down as an order. Now it's automatically going to put at the bid price. Always adjust this. So when you go to enter your order, it's going to give you this slider here. And this slider is going to show you the mid price. So that's that point right in the middle. You are going to want to turn up your order to the mid price, okay? Because you want to split that buyer and seller, and you want to throw your offer out there in the middle, see if it's enough for them to come up and take a nibble at. So what this means for this particular strike on September 27th is if I were to get a fill at this midpoint, if the market was open, I would be getting paid $206 to buy the shares of ALB, 100 of them, because I'm only doing one contract, for $70. Now, if we go back to when I actually placed the trade on ALB, I had arrived at the $70. That was kind of on the more higher end of that range of the levels, and it was around what was known as a 30 delta. So there's basically about a 30% chance that ALB was going to reach down there to $70 before the expiration that I did. Now, I did the monthly expiration, but that was at the time closer to that, 41 days to expiration. So that was on August 12th. And so I sold that that 30 delta. The stock was trading at about $76, so that was about a $6 move down. And I sold that for $2.58, and I went ahead and sold 2 contracts. So I collected $516. Remember, each contract represents 100 shares, so that $2.58 is $258 per contract. I did 2 contracts. Now, it takes buying power because your broker says, hey, you might have to fulfill this obligation and be assigned these shares. So I'm going to hold back a particular amount of your buying power just while you hold this position. So this position was about $1,400 per contract. So I had to give up about $2,800 of buying power for these 2 contracts. And if you do a quick calculation of return on capital here, you can say, hey, you collected $516, giving up $2,800 in buying power. That's roughly an 18% return on capital. So to kind of put this into a little bit of perspective, I'm going to stick with the expiration that we had, and I'm going to show a little compare and contrast on buying power at different strikes or different levels. So I went ahead and I chose the $74 strike. Now this was trading at almost $80, so it's about a $6 move. This is the 30 delta, so this is going to be very close to a similar situation of what I traded as far as days to expiration, premium that you collected around that 258, the delta. Volatility is a little bit lower than when I sold, so the premium is not quite as good. But I want to kind of call your attention to is the buying power and what you might do. So I have 2 different trades here. I have going long 200 shares, and then I also have, selling 2 puts at that 258. And so if you long 200 shares of ALB, one, you'd be going long at, $79.50, but this is going to pull down $11,000 in buying power to hold this 79 or to buy at $79.50. Now, on the flip side, I can be more efficient with my capital. I mean, I can have the capital to purchase, those 200 shares should we get down to that $70. But if I look at the capital required for selling just the short put and I remove the long stock, you can see it's about $2,800 is all it takes for me to sell those 2 puts. This is a much more efficient use of my capital than buying long shares, and it's going to pay me to wait. So you could say, well, why don't I just put a limit order in and my limit order will fill when the price gets to $70. You could do that if an immediate fill is important to you, because a limit order will fill immediately once it hits that price. However, you don't get anything for that limit order. So if you have patience, you can go ahead and sell a put at that $70, which is like a limit order because it says you are obligated to purchase it at $70, but you're going to collect premium for, allowing somebody to do that assignment to you. And if it gets below 70, okay, great, you buy it at 70. But if it never gets below 70, you get to keep that money. And then when it expires worthless, and you can sell another one. And so to me, you're going to make money as you're waiting for your price. And that's the biggest thing when it comes to short puts. So that brings us to the end of this week's episode. I hope this kind of makes sense to you. When it comes to beginners, a lot of beginners never have sold options. If they touched options, they're probably buying options. For me, I really think the premium selling is the way to go. And one of the easiest training wheels or most similar training wheels to a lot of new investors or new traders when it comes to options is selling the put, selling the naked put. And the reason for that is it's closest to the traditional limit order where you say, I'll buy at this price, and you put an order out there. The only difference is when you sell options, you're getting paid to place that order. Whereas limit order, you basically just put the order out there. If it hits, it hits. You get nothing for it. With the selling the option, you're going to make money in 2 directions. You're going to make money if the stock goes up because your put is going to just lose value, and you're going to keep that premium that you collected. You don't get assigned, but guess what? If you're going to buy at $70 and the stock just went up, you weren't going to hit your limit order anyway, so you might as well collect money while you're waiting. Now, if the stock doesn't go anywhere and it just kind of dances around wherever it is, 76, 75, 74, 76, doesn't go anywhere before expiration, again, you're going to make money because you keep that premium that you sold. So, again, in that case, your limit order wouldn't have hit and you wouldn't have lost any money, you wouldn't have gained any money, you'd been nowhere. So that's a benefit for you. Now, if the stock goes down and it happens to go down enough to go below the strike, then you get assigned and you pay for the stock what you wanted to pay. That's why it's very, very important back at the beginning where I said you have to be okay purchasing the stock at the strike that you sell the put for. So if you're already going to go long these shares, from my perspective, that is the only outcome is a win. You either make money if it goes up, you make money if it doesn't go anywhere, and you get what you wanted if it goes down below your strike because you get assigned and now you're long those shares. Now, another nice thing about the volatility factor, when you go into this with really high volatility, not only will you get a lot of your premium because it's going to be more expensive of an option and you're going to sell it and collect all that premium, it also means that the stock is going to be more explosive. So, in the best case scenario, you come down below your strike, you get assigned, and that volatility helps it explode to the upside. And now you're going to profit from the long-term gains. And because your thesis was you wanted to go long on this thing from the beginning, it really goes back to that kind of triple win scenario. So my recommendation to you is to go out, pick a stock that you want to go long on, check the things that I talked about, go into the option chain, look for that tight bid-ask spread, pick the strike that you want to purchase at, go into that 35 to 45 days and sell an option at that strike. Remember to adjust the price to a midpoint. Do not put your order out there simply for the bid. Because you will absolutely get filled, which is cool, but you're not going to get filled at your best price. So go for the midpoint. If it doesn't fill within a couple of seconds, go ahead and click it down. If it doesn't fill, click it down. And that's how you walk around to really do a price exploration to figure out where it's going to sell at. If you want to get, uber good to get the best fill, start your orders at the ask and then step down penny by penny by penny. Chances are you're not going to get filled until you hit the midpoint or go below the midpoint, but you never know. So if you really want to do that and you have a little bit of time, put it out there. You don't need to wait multiple seconds or anything like that. You can just wait 1, 2, 3. Okay, lower it. 1, 2, 3, lower it and walk the order down. And as long as you're already wanting to get own the shares long, there's really no risk here because worst case scenario, you get assigned the shares. Best case scenario, you keep the money and you don't have to buy the shares. I guess depending on your perspective, maybe that's the worst case scenario. The best case scenario is you get assigned. But either way, it is a way that you can experiment and understand and play with selling options, and really you'll start to grasp the power of that theta decay and the power of the delta and the power of getting paid to wait. Well, hopefully out there in the market, you are finding something that matches your strategy and your comfort. So there's a lot going on. We got more interest rate talks. We got the Fed Jackson Hole coming up. We got the Fed meeting in September coming up. So good luck out there. Have fun. And remember, think outside the block.